Yes, hello everybody. Welcome again to another webinar. So today we have with us Thomas Nastas, and we are going to talk about how to come up with a sound business case, and we'll put emphasis on risk, how to actually calculate the risk within a startup. So Tom is actually a very experienced person. He's the founder of Innovative Ventures. He created venture funds for over $750 million. So he's very experienced when it comes to investing in companies, and it's really great to have you with us, Tom. So the floor is yours.
Thank you. Can you see? I've got some dialog boxes open, so I'm going to minimize some of them, and you can tell me if this looks okay. Well, here's what I would like to chat about. Is I want to kind of frame the discussion on risk, and rather than talk about specific numbers, everybody has their own particular idea about how do they create a business model, and I'm sure that all of your entrepreneurial teams are familiar with this guy Steve Blank, who writes an excellent blog about customer discovery and customer analysis. And if you haven't read his blog, I would encourage all of you to do so. In fact, actually, he just put out another one today, and then he did one last week. I think were very good. But I want to talk about how risk drives investor behavior, because a lot of times so much attention is paid to coming up with a good pitch deck, but maybe one of the ways that you could be hopefully a little bit more successful is thinking about how can you shape your business model not only to the behavior of your customers, but also to the behavior of your investors or potential investors in trying to raise money. And when we talk about United States venture capital in Silicon Valley, I want to give you a perspective of myself, because I've been doing venture capital since 1986, and then about 1992 is when I left America and then set up these funds in Canada and Europe and in Africa, Russia, and most of these funds are all closed, and now I have a very large investment program that we're doing in Kazakhstan, where we're financing technology in what's called from the stage of proof of concept through commercialization. And but there's two fundamental differences between what I would call U.S. venture capital and every place around the world. And then, for example, in Silicon Valley, one of the things that's always sort of idolized is entrepreneurship and failure, with the idea that in the United States, or specifically more in Silicon Valley, is that if you fail once or twice, you can come back and raise money. But in most markets that I've worked in, unfortunately, that's not true. In Michigan, where I'm originally from, if you fail, well, you're essentially put in a penalty box for a couple of years, and then you can raise money. But in many of the international markets, and specifically the emerging markets, if you fail, you're basically a loser for life, never to raise money again. So if you're in that kind of an environment, you have to think about what kind of business models are you going to attempt to launch in your particular country. And so that's one fundamental difference. There's a second fundamental difference, which is that in the United States, and again probably more so in Silicon Valley than other places, is that there's this notion of experimentation, trial and error, and that equals learning. But in most emerging countries, international markets, when you spend money and you achieve no results, that again puts you in the category of being a failure. And investors are very unwilling to finance trial and error experimentation. So if you're in that kind of an environment, which exists in Europe, it exists in East Europe, it exists in the former Soviet Union, where I spent much time and much of my investment career in, is you have to think about what kind of business models can you actually launch in your particular country, and then try to gain some traction, and then do some activities that maybe might be a little bit more ambitious. And typically, I start a sort of I want to start this conversation and I use some examples of some Russian oligarchs, and you can see that You know, here's 4 pictures of 4 Russian oligarchs, and their net worth is anywhere between, what, 11 billion and, what, $18 billion. And a lot of times I ask entrepreneurs, I say, well, how come these guys are not investing in your technology ventures? And they typically tell me there's 1 of 3 reasons. One is they say that they don't take risk. And what I like to do is show them this particular project. It's a big construction site in Moscow. And for several years, this site was basically no activity. There were no customers. There was no cash flow. There was no revenue. And yet the invested capital was about $2.5 to $3 billion. And so when entrepreneurs tell me they don't take risk, I say, gee, you know, here you've got a project where wealthy guys put in, you know, $2-3 billion, no cash flow, no customers, no revenues. Gee, that seems like big risk to me. And so then the second reason they say is that these guys don't like startup projects. And typically what I do is I show them this picture, and of course every construction site starts as a big hole in the ground, which to me is a startup project. So in fact, they actually do startup projects. And then the third reason that I've typically given is that, well, gee, a lot of times it's technology. It's, you know, it's not very big money. It's small money, and you can't make you can't actually create some wealth. And then I actually show this picture, which is the IPO valuation of Yandex, which is sort of what some people would call a Google competitor in the Russian market, and they went public on Nastas a few years ago at a valuation of $11 billion. And then a little bit before that was the IPO of Mail.ru, again, which is sort of a Google Yandex competitor, which went public on the AIM market in London with a valuation of $5 billion. So I use this to sort of dispel some myths about what investors will and won't finance. And in fact, they do finance startup projects. They do finance projects that create wealth, and they do finance projects where there's a great bit of risk associated with them. But I want to show and talk about this and talk about what you might be able to do as you start to think about framing your business model. And typically, in both U.S. markets, European, and the emerging markets, think about not what investors, don't think about what opportunities investors buy, but think about the risks that they buy. And typically risks that they buy include things like real estate, food and beverage, retail, wholesaling, logistics, mining and minerals, manufacturing, because they know that if they are successful in execution, then there are markets and there are customers, and those are guaranteed. And so that they will achieve a result if the execution is successful. But in technology, typically, there are 4 sets of risk. One is, does a market exist? 2, will the technology work? 3, will customers get it? And then 4th, will they pay? So the topic of this discussion is how might you deal with uncertainty in business modeling? And so I'm going to talk about each of these, and I'm going to talk about an example of a sort of a virus that's sweeping around the world, which has raised huge amounts of capital, not only in the development markets, but also in the emerging markets. And the question is how can you impact the DNA of investors, both for, you know, venture stage SMEs, for technology, for innovation? And the question you always want to ask yourself is it possible to shape your deal to the DNA of investors? Because if you in fact can do that, then the likelihood of your raising money will be increased, and then you're on the way to launching and deploying your business model in a particular marketplace. So think about what business models will actually match the risk behavior of local money, not only in emerging markets, but in European markets, risk which domestic investors typically will buy. And I want to talk about an example from Russia. There was a company called Darbury, which, as you can see here, several years ago they raised $10,000 to essentially do a Groupon clone in the Russian market. They only had a staff of 3 people. They basically just localized the website to particularities in the Russian market. Then in May of 2010, they raised $50,000. They launched. In July 2010, they raised another $100,000. And in August 2010, they were acquired by Groupon. And the reason why I mentioned this is because what it did is it demonstrated that cloning essentially had the characteristics of expansion stage companies, where it demonstrated, yes, there's a market, yes, customers understand it, yes, customers pay money. And the only risk that existed would the technology work? But the technology risk was essentially, could these guys essentially localize the Groupon clone to the Russian market, which they did. And what it created in Russia and a number of other countries, and this is data as of about 2 months ago, at last count there were over 80 deals transacted, and 45 early stage SMEs with total capital over $1 billion, with a deal size of between $100,000 and $90 million. And some of these clones actually have raised big money to deploy their business model. And so what these clones did is they circumvented the risks that typically scare local money, which is low investment. They had big and fast revenues, and they were able to launch from concept to execution in 3 to 6 months. So as you start to think about your business model, I want you to continually think about these 4 risks that exist with any business model, which is, does a market exist? Will the technology work? Do customers get it? And then will they pay money? And with that, I think maybe what we do now is open it up to any questions, if some exist. Either verbal or chat.
Exactly. So if you do have any questions, please post them again in the chat area. And if you want to go live directly, just raise your hand on the left side. If any questions you have so far? Yes, there's one question. No, there's no question.
No question.
So far, there are questionless.
Okay, maybe we turn it around and ask some of the attendees some questions about issues they're having in creating their own particular business model and the challenges that they're experiencing on either customer discovery, customer analysis, and or creating the business model for the business case.
So in the meantime, while we give the participants also time to think about questions, I would start off with the first question.
Sure.
And my question is, how do you, in an early phase, how do you present your numbers to an investor? So we typically know that the cost side, that's something which is pretty clear, or you should know about your cost. But when it comes to revenues, everyone struggles. And then there is this huge question, well, how do I present my business to an investor? If I come up with a typical hockey stick graph, then the investor is on the one side happy because the investor knows, okay, if I invest in this company, then at least in a few years it's expected that I'll make some profit. On the other side, everyone is coming along with the hockey stick graph. So what is your opinion on that?
Well, my opinion is to be truthful at all times. Projections are projections, and of course you're making an assumption based upon how customers are going to adopt your particular product or service, in what particular volumes. So you need to be able to think about your projections. Now, there's two ways to look at this. One is to make a case saying, well, people are going to adopt this at this particular adoption period over this particular time. But one of the ways you could also look at coming up with the projections is say to yourself, look, if I have to personally sell this particular product, how many sales calls can I make per day? Let's presuming that you're launching something where it requires a personal selling effort. So if you, for example, if you can make 5 sales calls a day, and you know that you're going to close, say, 1 of those per day, then that sort of defines what your projections will be over some period of time. And then your scale up is going to be based upon how many more customers you can get either through your personal selling effort or by adding salespeople or by having the market communicate with one another, which will then increase, how many customers potentially can increase, or how many customers can potentially buy your product or service.
So what you're saying is that I should always think about my resources that I have within the company. Also, obviously.
Absolutely, absolutely. Because a lot of times you see these projections, which are, again, they show a very slow ramp up, and then they show this increasing sort of linear exponential growth. But typically, sales don't happen in that way. Sometimes they go up, and then they go down, they flatten out for some period of time, and then there's some particular milestone or tipping point which causes sales to increase dramatically. In some cases, sales can actually look like an S-curve. So the curve would look like this and then go up. Again, different kinds of situations for different kinds of products or services. But it is a function of how much resources you could put into your particular sales effort, whether it's web-based or online-based, or whether it's it has to deal with quite a bit of personal selling.
All right. And then there is a question coming in from Philip, and he's asking, how do you realize as a startup that you're within the hockey stick curve?
How do you know that?
Exactly. How do you know that? And my question in combination with that would be, okay, how do I understand whether my business is following a hockey curve or whether there is something like an S curve? How can I come up with the numbers? Where do I find those numbers?
Yeah, it's not necessarily finding numbers, but what you'll typically find is that sales will be increasing proportionally much greater than your cost, and that will be an indicator of scaling. So what you can typically do is you can do a marginal cost analysis, and you can look at what percentage increase is there in your marginal cost versus the percentage increase in your sales. And if you see that your sales are increasing rapidly or faster than your increase in cost, then typically you might be at that particular peak point where you're coming to that tipping point, and now you're starting to see some kind of a hockey curve growth. Because the whole idea of scaling is that revenues are increasing proportionally much greater on a percentage basis than is your cost.
Mm-hmm. And there's another question. What are the most important metrics you're looking at? So when you say you have a lot of experience like from the investment side, and you look at a startup, you analyze it. Like when you look at the numbers, what are the most important metrics or most important numbers you're looking at?
I look at 2 numbers: revenues and profitability are the 2 numbers I look at, and especially from the emerging markets, where I've spent about the last almost 20 years, is the biggest thing that we look at always is profitability. Everything else is secondary, whether it's different kinds of metrics that show user engagement, because typically we want to be able to see profits, because profits are what drive the behavior of investors in these emerging markets.
Mm-hmm. And what classifies a good as we call it here, a business case, in the sense of what classifies whether the numbers are done in a good way?
What do you mean? I'm not sure. I'm not sure of the question.
I mean, when you look at a startup and you say you look at profitability and you look at revenue, when or what makes you trust in those numbers? And when is the point where you say, okay, I'm getting those numbers, but I'm not really trusting them? When do you have the feeling that, well, they have done a good homework, the numbers are trustworthy? And when is the feeling when you say, I'm not really sure if they, if the numbers are trustworthy, if they really know what's going on?
Okay. Really, there's actually two data points. One is in discussion with the entrepreneur or the founding team. Is how much confidence do they have that they understand what drives customer behavior? So that's data point number one. And then data point number two for me is I'm always talking with who they perceive to be as their potential customers and try to get some indication that that their intention to buy will actually result in actual behavior, which is what they'll buy. So I actually spend quite a bit of time talking with customers on what they're trying to achieve and how this particular product or service is helping them achieve it. And I ask them essentially 4 questions. I say, well, whatever you're doing now, how is that done now? And then I ask them, I said, well, what does that cost you in terms of either direct costs or indirect costs? And third is I say, okay, well, here this company has produced supposedly this particular improvement. And I try to validate if that improvement really is something that will cause them to open up their pocketbooks and then try to make some kind of an assessment. Again, it's qualitative assessments on what is the value of this innovation to them. So I use 2 data points. One is talking with the founders and the founding team, and then 2 is sampling potential customers, some of which the founding team may have suggested that I speak with. And then I have to try to do my own data analysis and talk to customers that are within that particular target market. And that's how I try to get some sense of whether these numbers are realistic or they're not realistic. And then using that as a basis of determining, is this business model, does it seem viable or not?
Mm-hmm. Interesting. Then there is another question coming in from Philip, and he's asking, you as a VC, are you concentrating on a limited range of branches, or are you specialized in a certain branch or industry?
Well, in the past, the funds that I showed were sort of industry specific. The first sets of funds were seed and early stage venture funds that focused predominantly, although not exclusively, on what we call ICT, so hardware, software, and telecommunications. In Russia, the first fund was not what we call a venture capital fund. It was actually a private equity fund where we were financing privatizations and then entrepreneurs that sort of grew up out of sort of the perestroika days. And that's the same also in Africa. The second fund in Russia was very specific. It was a corporate venture fund that we created with Shell Oil and Shell Technology Ventures, which was to finance technologies in the oil business, mainly in oil field services, predominantly in the area of upstream. And then in Kazakhstan, we're focused in on a variety of technologies in agriculture, in medical, biopharma, nanotechnology, construction, oil and gas, and 2 or 3 other sectors in Kazakhstan.
All right, thank you for that. So there's another question coming in, and the person is asking, so you talked about identifying and mitigating risks before you get investment, but it shouldn't stop there. But I don't think many startups have a kind of risk management structure. So the question is, so you talked about identifying and mitigating risks before you get investment. Okay. But I don't think many startups have any kind of risk management structure in place in the early stages. Shouldn't there be more formal risk management, or is the whole startup process in itself just a big risk management process and can't use more classic risk management processes?
Well, I mean, there's lots of different ways to look at risk, and there's lots of different management techniques. But I like to look at a startup and an early stage company by at least asking them 4 questions. One is, let's demonstrate that there's a market that exists, or that one that can be developed with your particular business model, whatever that might be. 2 is, then let's start to look at what it is that particular market what that particular market needs, and what's the product or service that you're going to offer to them, and what are the performance characteristics or criteria that they need. And then 3rd is, will customers, if you launch this particular product or service, will they understand what it is, and will they pay money in some particular form? So I don't look at this as some particular, using quantitative analysis to try to figure out risk. It's very qualitative. There's a market? Will the technology work? And if so, what are the performance characteristics that you need to hit or to meet? 3rd is, will customers pay? And are they accustomed to paying for something that you're offering? And 4th, will they understand what it is that you're offering, or will it be required a long, very long period to explain what it is that you're doing to the marketplace? And that's the way I look at making investments in early stage companies or startup companies.
Mm-hmm. And then there's a question coming in from Alena. Alena is asking, what are, in your opinion, the main barriers which can complicate cloning the European business model to Russia? What can make it especially difficult to use the European-American model in Russia? Because she's coming from Russia.
Yeah, well, what I found is that, again, this whole idea of cloning from either United States, either established business models in U.S. or in Europe, and taking them whether it's to Russia or to Kazakhstan or to Ukraine or really even to East Europe, is you need to look at who are the customers that have purchased these kinds of products in America, and do these customers exist, say, either in East Europe or the former Soviet Union. And my experience has been, again, is that many of these clones have done incredibly well in these markets as consumer income increases, as people look to have a better life, to have a better quality of life. They're looking for more diversified products or services. Then these cloning opportunities have just developed over time. And it's been absolutely just a remarkable phenomena to observe and invest in these things in Russia, as it is in most other countries, whether it's in East Europe, whether it's in most of the countries in Latin America or in Africa.
Mm-hmm. And I do have also another question for you. So when we look at investors, typically you have I would say two approaches. One approach is, and that's the approach I hear most recently, is when we, as an investor, when we invest in a company, we usually try also to be heavily involved in the management. And if we do an investment, we want the company to sit at our space, at our incubator or accelerator, however they name it. And there's another side of investors, and they say, okay, once I trust a team, I will invest in them. And once I invest in them, obviously I'm there to help them out with important strategic issues. But other than that, I'm not really involving myself. What is your take on that? And maybe shooting also, second question is, like from the side of startup teams, what should they look at when going for an investment? How should they assess investors? What is your opinion?
Yeah, second question, yeah. I mean, again, different kinds of investors will have different comfort levels of investing. Some will be a little bit more hands-off, where they feel that once they've made a decision on with the founder and the founding team, they've agreed on valuation and what the capital will be, is they're there to help support the company. Others, what they want to do is they want to be very hands-on. They want to be active with the management team and help them prevent what they might feel they might help. They might think that they're helping prevent mistakes from happening. I don't think there's any right or wrong answer to that. I think it's just a question of the experience of the investor team, what experience that they had in the operations of young companies in that particular market, and in many cases, sometimes they can provide excellent hands-on assistance to the founding team. So it's really, I think, very situational. The second question, I think, is a very interesting question, and I think it's a very good question, because I think that as a founding team, you want to be able to have an investor or an investing group that you feel that you're aligned with. Lots of times, people take money because they feel that they have to have the capital. And they think that capital is fungible, and where the capital comes from is basically irrelevant, which is not the case. There are lots of times when investors can basically be, what's the word I want to use? They can be overly aggressive. They can be overly demanding. They can be they don't have feelings of trust in part of the management team. And, those kinds of relationships will typically turn out to be a very bad marriage for all people involved. So just like the investing team interviews and evaluates the founding team, I also recommend that the founding team and the entrepreneurs interview the investors. And not only interview the investors, but also attempt to evaluate this notion of what's called value added, which investors typically say that they provide to their investee companies or their portfolio companies. Try to gauge, in fact, if that's actually true and what level or what amount of that value added is given by talking to various members of the management team of the investors' portfolio companies. So try to get an evaluation not only on the part of the investors and who they are, their experiences, and where you think that they can actually make a contribution to your business, but also validate that by talking with the managers of their portfolio companies.
And what would you say? How do I find the right investors? So now we have been talking that, okay, once I'm sitting together with the investors to try to assess them, but how do I find them? And how do I, if I'm new in the market, I say I'm looking for an investment, what do I do? What would you say is a good approach, knowing the scene?
Well, I think it's sort of like looking for a boyfriend, girlfriend, husband, wife. You start talking to a whole lot of people, and you work the phones, and you work your network and your support system, and talk to fellow entrepreneurs, talk to investors, and get a sense of what it is that's driving them to make investment decisions, and whether your particular business model and your particular business case falls within what we call their sweet spot, which is the area that they're making investments in. I've got good friends in Boulder, Colorado at what's called the Founders Group, Brad Feld and his team, and they invest in specific spheres. They have a specific investment thesis. And so one of the things you want to do is try to identify investors that are investing in the thesis that your business model is part of, so that you don't waste time in talking and trying to present your business model to an investor that says, look, this just isn't in our area of expertise or our area of focus. But you talk to a lot of people. You go to startup events, startup weekends. There's a number of different resources, online and offline, where you can get lists of investors, either angel investors or venture funds or private equity funds or wealthy families. And and just start talking to these people and try to get a sense of what the investors are out, what their appetite is looking for, and then start to approach them and say, look, here's what we're doing, and here's our level of expertise, and here's the accomplishments we've made. What's your reaction to that? That would be my recommendation.
And then there's another question coming in asking, does it make sense to send an investor something like a two-pager about your startup, or do you prefer recommendations from others, and what is the best approach? And I have seen, recently I've seen a few numbers about successful investments, and they clearly showed that those startups who have been recommended, where another investor or a startup that has been invested by the investor referred the startup to the investor, the chance that they got an investment was significantly higher than something like a cold call. And I think what Philip refers here to is something like sending a two-pager. What is your opinion on that?
Yeah, there's a lot of merit to this idea of being introduced to an investor, either from a friend of an investor. Typically, you know, there are the service providers, whether they're accountants or lawyers or PR firms or marketing or media firms, which typically sometimes you know, make an introduction. And the whole idea of this is this idea of filtering, and who do you associate yourself with, and who has or who will give you their support. So there's a lot of truth to working through the network and trying to get a referral to meet a particular investor. There's also another technique which I think is a bit underutilized, which is that some companies have been able to approach investors and actually raise money by providing a service, either a product or service, to one of their investee companies, and use that as a way to get an introduction to an investor group. So, for example, you might be doing something in, I don't know, you might be doing something in the area of medical devices, and you're a provider, you're a supplier to the company of medical devices, and that medical device company has raised money, say, from some particular investor group, and maybe what you could do then is to use that supply chain relationship, the customer, vendor, supply relationship, as a way to be able to meet an investor, either for that company or for some investors who are in that space, which would be another good way to approach investors.
And when would you say is the right time to approach an investor? And speaking about two sides, like right time in the sense of the stage I'm in as a company, so very early stage, a bit later stage, how important is bootstrapping, and the second point also looking at the fund of the investor. So usually, or sometimes you hear that it makes sense to not be try to be the first, like when a fund opens, to be the first deal, but wait a bit and then be the third, fourth, fifth deal. So what is your opinion on that?
Yeah. Well, I think the wrong time to try to raise capital is when you're desperate, when you realize that the cash that you've got in the bank isn't going to sustain you for a 6-month period. I think that's a bad time, because now all of a sudden you're desperate, and people will sense that you're desperate, and it'll put you under tremendous pressure and tremendous stress that you don't need to be under. I'm always a firm believer of getting to know investors earlier rather than later, and one of the ways you can do that is by attending many of the conferences that exist in West Europe or East Europe or other places that you can attend, where you can start to meet investors. And again, a lot of times people want to be able to meet sort of like what they conceive to be as the top decision maker at a particular investment group. But certainly talk to the associates and get to know the associates and start to understand kinds of transactions they've done. Maybe one of the things you could do in those discussions is, when you start to meet investors, start to look at their portfolio, companies they've made investment in, and look and see whether there might be an opportunity for you to actually be a supplier to one of their investee companies, as again, as a way to demonstrate your contribution in the marketplace. And because if you can help one of the investors, investee companies be successful, that will increase your likelihood to get an audience with them and actually to engage in serious discussions with them.
Mm-hmm. Thank you for that. And there's another question coming in. And the person asking is, so you're not reading VentureBeat or TechCrunch and make up your minds to invest in one of the companies an article is published about? So this all refers again to where does an investor, if an investor is actively searching for deals, where does an investor find his deals?
That's partially a function of how big of a team you have. If you have a big enough team, investment team, then what I call sort of the associates or the assistants can be, reading a variety of, either blogs or the media or again, TechCrunch or these kinds of. There's another website called VentureBird, which is out of Johannesburg, South Africa. You can read these to try to identify emerging companies and use that as a way to reach out to them. But if you've got a small staff, sometimes that's just not as possible, and you tend to be a little bit more either reactive in terms of waiting or getting referrals. In some cases, some investor groups like ourselves, we have some particular expertise in some particular domain. And so we understand what customers are looking for. And when we understand what customers are looking for, then we can use that as a way to go into the marketplace and looking for companies that potentially might be doing something identical to it, or maybe they're in that space or in that area that we might be able to approach and then start to have a meaningful dialogue.
Mm-hmm. Mm-hmm. And then there is a second question tied to the first question. So he's asking, how about Kickstarter projects? So if you see a project that is maybe has been successful in raising money from the crowd, would that be an interesting indicator in terms of, well, there is a large basis of people who support this project and are maybe also interested as customers in this project? What is your opinion?
I mean, I love Kickstarter. I think these crowdsourcing platforms are terrific, and they're terrific for I like it for two reasons. One, it's a way to be able to validate whether customers will actually come and actually pay money for this, number one. And then number two is it indicates to me as this team, if they've raised money on, again, one of these crowdfunding sources, can they execute? Because we hear lots of cases where companies that have raised capital, which indicates that customers are interested, they want the product, they want the service, but they've run into a variety of execution issues. So it really is able to demonstrate to me their ability to execute into the marketplace. But I love them. I think, the crowdsourcing sites are absolutely terrific. Recognizing that, again, most of the projects on these crowdsourcing tend to fall into not what I call company projects, but individual sort of creator projects like music or books or artwork or pictures, that kind of a thing. Although we're starting to see more and more companies use this as a way not only to raise capital, but also to validate their market, validate their business model, and then they can actually use this to demonstrate their ability to execute in the marketplace. And there's another aspect, which is that if there are slip-ups in execution, which there always are, is that the people that have funded through these crowdsourcings can somewhat tend to be a little bit more forgiving than investors will be. So again, I think these crowdsourcing platforms are absolutely just a terrific model for the investment business and the venture business.
So Tom, very often when you talk about interesting companies and what makes them interesting for an investor, you use the term execution. And so the question I have is, as a young company, usually or let's say it's a very young company, when you come out of university or you're still in university, what you usually lack is people that have a very good knowledge of the market. So you have in your team maybe people that have knowledge about a specific technology, that are really fascinated about doing something, but I would doubt that many of them have really a deep knowledge of how to run a company, how to execute. What is your suggestion on that? Should they look for a new team member that is experienced in the market, or should they try to hire that specific person, or should they wait and learn by themselves? What is your opinion on that?
Okay, there's essentially sort of like two questions that. One, which is the founding team doesn't have a very deep knowledge of the marketplace. If you don't have a deep understanding of the marketplace, that could get you into trouble pretty fast. Certainly there have been cases where founding teams have launched and through their sort of their intuition, they were able to hit the sweet spot of the market and they were very successful. But in most cases, you need to have a very deep understanding of what drives customers to make some particular purchase decision. And it can be as simple as, will they pull out their wallet and buying it? You also need to, for example, understand, look, maybe you've got a superior innovation and it's going to be 10 or 15% cheaper than some particular competitive offering, but it isn't significant enough for a customer to incur what we call switching costs, which means they're going to switch their purchases from one competitor, from one company to your own, because now they're dealing with an unknown supplier. Can they produce in the quantities needed? Will they produce at the quality required? Can they achieve all the performance targets that's required? Blah, blah, blah. So you've got to be able to have a very deep understanding of the marketplace and what drives customers and the customer behavior. That's number one. The second part of this question, which is, at least as I interpret it, which is, if the founding team is sort of short on people with execution skills, should the founding CEO or the founding partner or two partners, should they try to develop those skills in-house over time? Should they try to hire that talent, or perhaps potentially there's a third variant? I think that's a function of what you're I think that's a function of what you're doing in the marketplace and how much time actually the market will give you to be able to learn what you need to learn on your own versus, look, you've really hit a significant marketplace, and you can't afford to develop all of the skills you need in-house because others will see the opportunity and they'll start to exploit it. In those cases, then I think you need to start to look at how do we bring in the people that we need to augment our management team or our founding team, whether it's in execution in coding, whether it's in product development, whether it's in manufacture ramp up, whether it's in business development, whether it's in direct sales, whatever that might be.
So the second part of your answer, would that also relate to the point whether to get an investment or not? So in the sense of, we see that a lot of companies now, especially in the IT field, they think about bootstrapping. Instead of getting an investment and try to bootstrap, because then I don't need to give away shares. But again, here, I mean, when you bootstrap, is that you're slower, right? That you're way slower because you cannot have two coders, maybe you only have one code. Is that so? The question: when would you advise the team to turn an investment? Is it better from the resources you? What is your opinion?
Okay, Stefan,
bootstrap in a sense, your own resources, invest in your own money.
Yeah. Yeah, I mean, you broke up a little bit. As I understand, you're essentially saying is how does a founding team make a decision of should they attempt to bootstrap, and if so, for how long, or should they go and try to raise capital? I guess maybe fairly quickly or immediately. Again, it's my feeling of both investing and actually being an entrepreneur myself is to bootstrap. As a way to be able to demonstrate and validate the marketplace. Because when you do that, then you have got, essentially you're able to control the dialogue with investors much, much better. Because you're able to demonstrate, look, here's the market, here's how our product or service is working, these are the kinds of revenues we've generated, and here's our particular growth plan based upon the availability of our free cash flow to keep on reinvesting back in the business. Some businesses are very capital intensive, and you can't do that. I mean, you just unless you've got some real wealth behind you, whether it's family wealth or personal wealth. And in those cases, you're not able to do that. You're going to have to go out into the marketplace and raise capital, very quickly. But and it's my supposition, I could be wrong, but I think that most of your entrepreneurs participating in this founder's battle are predominantly looking sort of like IT, software, mobile kinds of applications, where the essentially the cost of development is basically to a large extent people costs. And I would look as hard as you can to continue to bootstrap as much as possible to be able to demonstrate what you're doing in the marketplace. And there are lots of companies that are very successful. I mean, for example, in the United States, if you look at the fastest 500 growing companies, private health companies in the United States as tabulated by Inc. magazine, only about 3 or 4% of those are ever financed by venture capital. All the other ones either bootstrapped it through customer revenues, they were able to finance it through their own means, maybe in combination with some debt, some loans. So look to see ways that you can actually try to bootstrap as much as you possibly can until you actually need that capital, and you can really know, where you're going to deploy that capital to achieve maximum increase in revenues, profitability, and market share.
Thank you for that. And there is a question coming in related to that. So what if there is a shortage within the founder team in terms of you think a special talent is missing? Would you invest into that company? Or would you tell them to go and come back as soon as you found an appropriate person?
Okay, again, a little bit disconnect. You're saying let's say that there's one particular skill set that's missing in a founding team. As an investor, would I invest with the expectation that they will find that person? Or would I say to them, look, find this person and then come back to me? Is that the question?
Exactly.
Again, it's not a sort of a either or. It's not a black or white answer that I can give you. It's really a function of what the company is doing at that particular time. Because in some cases, this particular critical skill, it's needed now, but in 6 months it may not be needed, or it might be that it's not a critical skill yet, but it will be, say, in 3 or 6 months, and then when and it's going to take you some time to be able to find that particular person. So I would start to look at, as an investor, I would say to the company, I'd say, look, guys, what you need to do is start to find, start to spend quite a bit of time searching for this particular piece of talent that you need. But of course, that requires that we all are aligned on what that particular key talent might be. And one of the things that I could do, maybe as an investor or other investors, is start to help you identify, that person, because, building this, what I call this gene pool, at the very early stages of the company is absolutely critical, because you want to have that gene pool established so that these people then have the appropriate incentives to be working 24/7 for the next 2 or 3 years, trying to get this venture well established and ongoing.
Right. So is there any further questions from the participants? Any further thing you want to know from Tom? You can also click on the hand raise button. Oh, the question is coming in are there any further slides you want to show us? Or was that your slide deck?
No, not really. I mean, I've showed the I've shown the ones that I think that are the most important. And again, the one that I think is and I'll just go to this one. This one right here is, let me see if I can minimize this so you can see it. Which is, this one is, what, always ask yourself, whatever business model we are creating, what we're trying to develop, where we're trying to be straight. How can we figure out if there's a market? If there is a market, what is it we're doing? Will the technology work? And what I mean by that is will the product achieve the performance standards, the performance criteria, the performance that customers deem necessary to be able to purchase the product? Will they understand it fairly quickly, or is there going to be a very long sales cycle of getting them to understand what it is that you're offering to the marketplace? And then will they actually pay money? In some cases they won't. We've got this phenomena going on versus, premium and freemium. And so you need to make that decision, because if you're in a marketplace where they're not paying, well then of course the value of your particular product or service may not be in the revenues that you generate, but in the value it provides some particular acquirer of your technology and how they embed it into their particular product or service. For example, as Instagram did with, or as Facebook did with Instagram. So this is the one really I get people focused in on, and I've tried to do this again very simply and very concretely as a way to be able to think about your business model as you work on its development and its execution.
All right, so there's maybe a last concluding question coming in.
Sure.
Looking at the Christmas tree behind you, the question is, did you already celebrate Christmas, or are you just a forward-looking guy?
No. I just set up the Christmas tree, but Christmas is not for another, 3.5 weeks or so.
Exactly. Yeah. Tom, thank you very much for this session. I think we got a lot of insights today. I think it was very, very interesting. For me, one of the best talks we had. A lot of great ideas, a lot of points to think about. And I also hope that the other participants enjoyed the session and that you did enjoy the session.
Okay.
And,
it was cool.
Yeah. Thank you very much for everything.
Okay. And Stephanie, we were going to speak on Skype for about 5 minutes after this?
We're going to speak on Skype, exactly.
Okay,
all right.
Good. I'm here
Thank
for
you
you.
very much.
Thank you.